Oil prices seem to have stabilized somewhat over the past week in a sign of hesitation on behalf of oil bulls to advance further. In today's report, we are going to have a look at the data related to the US oil market and continue to view the fundamentals surrounding the international oil market. To conclude the report, we will also provide a technical analysis of WTI's daily chart. Making a start with the US oil market data, we know that on Friday, Baker Hughes announced another reduction of active oil rigs in the US, reaching now 485, down from prior report of 488. It should be noted that it's the fourth consecutive drop of the number of active oil rigs in the US, implying an easing of oil demand, which could weigh on oil prices. On Tuesday, the API reported a slight increase of US oil inventories, implying that aggregated oil demand in the US was unable to surpass oil production levels. The picture became even more clear the following day as EIA also reported an increase of oil inventories. Overall, the bearish signals in the US oil market seems to become clearer, and should they intensify in the coming week, we may see them weigh on oil prices. It should be noted that the ongoing operation of the IDF in Gaza claimed the lives of dozens of Palestinians in air raids over the past few days. There is still no possible solution for the conflict on the horizon, while the situation seems about to escalate further with another operation of the IDF at the northern Israeli border with Lebanon. 5 countries have called on their nationals to leave Lebanon amid growing fears of a full-blown war between Israel and the Lebanese group Hezbollah. We tend to see the case of full conflict of Israel with Hezbollah as elevated, with chances being more in favor of such a scenario than not. Should there be a full-blown war between Hezbollah and Israel, the risk of escalating to a regional conflict with the participation of other forces rises as well, which in turn could have substantial bullish effect on oil prices. Over the coming days, we get from China and the US data related to economic activity in the manufacturing sectors of the two countries for June. On Sunday and Monday, we get from China the MBS and Caixin manufacturing PMI figures respectively, and should the two indicators show that Chinese factories are struggling to keep economic activity afloat, we may see the release having a bearish effect on oil prices, as it could imply reduced oil demand from China in the future. Similarly, on Monday, we get the ISM manufacturing PMI figure, and should the indicators reading show a wider contraction of economic activity for the US manufacturing sector, it could also have a bearish effect on oil prices, as it could imply also lowered oil demand in the future. Brazilian oil production seems to be rebounding and could set pressure on OPEC's low production level strategy to raise oil prices as the pressure for market share intensifies. Brazil had a marked drop of oil production levels at the start of the year as a number of wells underwent maintenance. It should be noted that the Latin American country is expected to be the third largest non-OPEC Plus oil producer right after the US and Canada, and that including the reduced oil production levels in the first half of the year. The increased oil production levels to come in the coming months are expected to ease supply strains in the oil market and could weigh on oil prices should such a substantial increase of Brazil's oil production be realized. WTI's price action seems to have stabilized just above the 80.25 support line. Given that on Tuesday the price action of the commodity has broken the upwards trend line guiding it since the 5th of June, we switch our bullish outlook for the commodity's price in favor, initially for a sideways movement bias given the interruption of the upwards movement. Furthermore, we note that the 100 and 200 moving averages have flattened out, also implying that possibility of a sideways motion. Yet we note that the RSI indicator remains above the reading of 50, implying the presence of a bullish residue in the psychology of market participants for WTI's price, while the Bollinger Bands have not narrowed, implying that there is still a possibility of increased volatility ahead. Should the bulls regain control over WTI's price, we may see it aiming, if not breaking, the 84.10 resistance line, with the next possible target being the 86.80 resistance level. Should the bears take over, we may see WTI's price breaking the 80.25 support line and aim for the 76.70 support level. As this report concludes, we would like to thank you for being part of our financial updates. From all of us here at IronFX, we wish you a solid trading.